Welcome, welcome. As people are getting on, there were quite a few people who registered for this webinar, but I want to respect your times. It is 11:01, so I'm gonna introduce. There's always an introduction period, so more people are going to jump on, so that's great. But hopefully, you're in the right webinar. This webinar is estimated taxes, what 60% of businesses are doing wrong, right? So last time I talked to the IRS, that's what they said. 60% of businesses are doing it wrong. Um, in the description of the webinar, we talked about how the fees have gone up, but I think it went up from 150 to 500. But more importantly, it's a fee we can avoid. So if it's a fee we can avoid, let's try to understand it so that we don't have to pay that fee. So the purpose of this webinar is to help you understand estimated taxes. We will be taking questions. Please put your questions in the chat. I'm going to put a chat message right here. So if you are new to Zoom, once I did that chat, you should have seen some blinking thing either in the top or the bottom or wherever your bar is. That's where you can feel free to enter questions in during the presentation. There's always going to be questions. That's okay. If you have a specific question about your specific business, that's okay too. Just email me, right? So the questions in the chat, try to keep them as general questions that you think everyone's going to benefit from that answer, right? Those who signed up are going to get slides sent to them. This is being recorded on YouTube, and here is our YouTube address. If you're watching this on YouTube later and you still want me to send the slides, email me. Again, my email is right here, and I'm going to put it on a slide in just a second. But the agenda is we're going to talk about who we are, why we're presenting this. We're going to talk about what estimated taxes are, so you understand just what they are in general, when and how to pay, tricks on calculating, and then some exceptions if you do get penalized. And then, of course, resources available, because that's what we're all about, is resources. So who am I? My name is Peter Harriman. I work for the Maine Small Business Development Center. Been here since 2015. I am hosted by the University of Southern Maine, and I cover primarily the Southern Maine area. As I said, my email address, my contact information if you need that. Who are we, though? We are 12 to 14 business advisors throughout the state. So if you want advising in person, we're within a reasonable drive time to you. Or there's, of course, virtual advising if you're doing Zoom or telephone or email. But it's no cost, confidential business advising for new and existing businesses, right? So half my clients are brand new to business, half of them are existing businesses. Because, hey, guess what? When you're in business and you're doing your thing, things come up, whether it be pricing, hiring people, marketing, the classics, or it comes, main family leave or the mandatory retirement or PPP and idle. Things happen in business. Business is not a stationary target, it's a moving target. So that's what we're here for, is to help you understand the landscape and hopefully help you make you a better business owner by understanding what's going on. Locations all throughout Maine are possible because we pair with other organizations. Again, I'm with the University of Southern Maine, but we also pair with Northern Maine Development and AVCOG, Androscoggin Valley Council of Governments, to make sure that we can cover the entire state of Maine. Again, what we do, business planning, strategy and growth, buying and selling. There are some limitations, though, to my great superpowers. I cannot provide legal, tax, or accounting advice, right? So when we're talking about estimated taxes, I'm trying to help you understand what they are. But if you need help to actually find the exact number, I can give you the tools, but I can't do it for you, right? So who is a small business, right? There's an SBA size standard, which 95% of Maine fits within as far as Maine businesses. It does have to be a Maine-based business, a for-profit business, and most industries, I say most because there are some exceptions. For example, but it's still illegal on the federal side. So we can't, because we get federal funding, we can't help with those types of businesses. Right now, if you're interested in getting some free confidential one-on-one advising, go to our website and then just smash that request advising button. You can fill out a form and we will get to you usually pretty quickly. Now, if a week's gone by, you still haven't heard from us, check your spam. Sometimes with like a main.edu, my emails will go right to spam. In all the other host organizations. The filters are great, but sometimes that happens. So we will get to you. Check your spam. If you still don't have it, let me know. Right. Again, we also have a YouTube channel. And by this time, we have quite a bit of content on there. So feel free to go to the playlist, and we've organized the content by category, right? And if you don't want to miss any of the new content, like a video like this, then just hit the subscribe button, right? And you will get notified when we put new content out there. On with the show, right? Because you didn't want to hear about this. You wanted to hear about estimated taxes. That's why you're here. So the big question is, what are estimated taxes, right? We were in business, maybe we're new to business, and we've heard all about I should be making estimated tax payments, but I don't really know what they are. Okay, well, the tax system in general with the United States is a pay-as-you-go system, right? The government is operating 24/7 throughout the year. So they need to get, just like any business, they need to get revenue throughout the year to make sure they can pay for their services. Now, as I noted, in 2022, the average penalty for not paying your estimated taxes was 150. Since then, interest rates have gone up quite a bit. So in 2023, that average penalty went up to $500. Right. Not to scare you. Again, what we're trying to do with this webinar is to make you understand what the taxes are and help you make that payment if you want. Right now, God bless him, I have a brother who's a plumber, and he says, I'm not going to pay any estimated taxes. I'll pay the penalty. So there are some people out there who are just going to pay the penalty. That's okay too. I'm just here to tell you this, if you don't want that penalty, this is how you go about it. Now, if we start with what employees do, right? So if you're an employee, bear with me here. If you're an employee, you're also paying estimated taxes, but your employer is withholding them from your paycheck, each paycheck, and then they're making the payment for you throughout the year. So even if you're an employee, you're still paying estimated taxes. But the big difference is you pay 7.65% of something called FICA, Social Security and Medicare. Your employer pays 7.65%. So that's a benefit of being an employee is you pay half, they pay half, right? So for an employee, you're paying estimated taxes as well, but you got the benefit of having someone else do all the legwork and chip in half of your FICA taxes. So that's the benefit of being an employee. Now, if you wanted to as an employee, you can also tell your employer to withhold more taxes than what your W-4 form might suggest, right? So you fill out the W-4 saying you're single, one kid, whatever, and then it tells you how many taxes to withhold. You can say, hey, I know it says that, but withhold more. And this will become important because there's a few tricks you can do with that, having your employer hold more if you have an employee in the household. Right. Now, for a business, you have to withhold your taxes and you have to make your own payments. So remember those taxes we just talked about for the federal income, there's state income, and there's the FICA, which when you're self-employed, they call it self-employment taxes, not FICA, but it's the same thing, Social Security and Medicare. They call it self-employment taxes and not FICA because rather than paying 7.65, the employee half, you as a business are going to be paying both halves, 15.3%, right? You're going to pay that, that's a federal tax. You're going to pay that to the IRS as part of your federal estimated tax. So you as a business are responsible for doing this versus when you're an employee, the employer is responsible for doing this. Or if you're a business, you have payroll and you're doing this for your employees, right? Now, most businesses are going to make 4 equal payments throughout the year if they've been open all year long. We're going to get to periods in a second. Seasonal businesses, if you're on here and you're a seasonal business, you can elect to do make unequal payments that is more aligned with how your income comes in, but it's not the default. So you need to file a form, and we'll get to that, to request that from the IRS. Otherwise, you're going to be with everyone else making 4 equal payments throughout the year. If you're a farmer or a fisher folk, hold on a second, 2 slides, we'll get to you. So I'm gonna throw this in because I looked at who had signed up for the webinar and we have a couple S Corps on there. So I want to let S Corps know, especially, that you're doing estimated taxes and you're doing a bit of both, right? And that's why I started with the employee. As an S Corp, you have an owner that's an employee on payroll. So you're going to be withholding their taxes and sending it in just like any other employee. So that's kind of like the employee estimated taxes. So you're going to have that system, the payroll system to deal with. And your estimated taxes as an S Corp is on that distribution. That's whatever's above and beyond, whatever you get on a what's called a K1 form. That's what you're paying estimated taxes on as an S Corp. So as an S Corp, you're going to be doing both, withholding as an employee and making estimated taxes on the distribution amount, the above and beyond. Now, I say if you want, because as I said before, because you have an employee, you could also just move that over and just pay more throughout your payroll and pay the estimated taxes that way and not have to do two systems. So again, you'd have your regular withholdings and just add more into that to cover the estimated taxes on the distribution. So a little trick for the S Corps. Now, farmers and fisher folk, and that's defined as making 2/3 of your estimated adjusted gross income. Whew, line 11 on your tax form as farming and fishing. That's where you get your income from. So with your particular industries, you can either pay your estimated taxes in one installment on or before January 15th, or if you're planning on filing your taxes early and you're filing them and paying all your taxes by March 1st, you can make that payment then. So there is a separate category for farmers and fisher folk. There is also that form that you can fill out if you're a seasonal folk. But otherwise, this presentation is going to go forward with most other businesses that are doing 4 equal installments throughout the year, or doing regular installments of taxes, right? So do I have to pay? Right. First, we want to understand, do I have to pay before I get into what I'm going to pay, right? So that comes down to 3 questions in one scenario, right? So first, do you expect to owe more than $1,000 in taxes? So that's not $1,000 in profit from your business, but $1,000 in taxes on the profit for your business during the tax year. Once you take out any other income taxes you might have paid as an employee, for instance. So let's say you worked as an employee for most of the year, and then you started your business on the last quarter of the year. Do you think that profit you made is going to equal $1,000 or more in taxes? If you don't think it's going to equal $1,000 or more in taxes, then guess what? You don't need to make an estimated tax payment. If it's under $1,000, you can just pay at the end of the year, no penalty. Do you expect your federal tax withholding, right, plus any other additional payments that you might have paid? So if you worked 3 parts of the year, and you think your withholding is going to pay at least 90% of the total tax you're going to owe that year, right? You don't have to make an estimated tax payment. Not really an estimated tax payment. You don't have to pay further estimated taxes because remember, you're paying 90% already. So if you think you've withheld 90% of what you owe for this year, then you don't have to make a further tax payment. The last question, and then we'll get to the scenario. Do you expect that your taxes will be the taxes that you're paying are at least 100% if you make 150 or under for your adjusted gross income? Again, that's line 11 on your taxes. If you think you made 150 or less, and you paid 100% of what you paid last year, or if you made above 150, you paid 110% of what you did last year, then you don't have to make additional estimated tax payments, right? You're already making tax payments, but you don't have to do more. So little note to the wise, when you hire an accountant to do your taxes, and if they give you coupon books to pay estimated taxes for the next year, this is what they're typically doing when they're trying to write those coupons. They just filed your taxes, and this method works really good for understanding your past taxes. So they just filed your taxes, they understand where your adjusted gross income is, so they know, okay, I have your taxes, I'm going to just break it up into 4 installments, do 100% or 110%, depending on my adjusted gross income. and I'm going to write coupons for next year, right? Now, if you do better than last year, you'll end up owing some money. If you do worse, you'll end up getting a refund. But that's a really easy way for businesses that have already done a full year of business. A really easy way to understand year 2 and 3 and 4 is you just look at that past year and you do 100% or 110% depending on where your income falls, right? So that's an easy way to find out what your estimated taxes are. The unlikely scenario. So if you go to the IRS website, they have this scenario on their website as far as this is a scenario when you don't have to pay estimated taxes. So I felt I should include it. Number one, you had no tax liability for the prior year, or you did not have to file a tax return. Two, you're a US citizen or resident alien for the whole year. Or three, your prior tax year covered a 12-month period, right? Now I say unlikely because that number one is kind of hard. You had no tax liability for the prior year. But again, it was on the website, so I want to make sure we covered that as well. Okay, so we went through the 3 questions. We went through the scenario. Shucks, I have to pay, right? Because I don't fit any of those scenarios. So when do I pay? So you pay when you start your business, right? So if you're already been in business for a couple of years, you're gonna keep going. But this will get a little more. I'll get to a calendar in a second. So most people go by the calendar year. They go by January to December as a calendar year, January 1st to December 31st. So if you have a calendar year, this is what the payment schedule is. Now, I want to be very clear. This does not mean you only make a payment on the income earned during these months of when the income was earned. So it's a little misleading by the IRS, but we're looking at the due date, right? So what this is saying is, hey, if I started my business June 10th, I don't have to worry about the April 15th or the June 15th estimated tax date because I wasn't in business during that period. But I was in business for the third payment, right? So I am going to have a payment due September 16th, right? So that's how you're using the schedule. And the schedule is a little wonky because right in the middle here, you can see that it isn't quite the 3-month quarters we think of. In fact, the first 3 months is a quarter, but then there's a 2-month period, and then a 3-month period, and then a 4-month period, right? I don't know why they did the schedule like this. I do not know why. Do not shoot the messenger, right? But what I need you to know is these aren't saying just pay the income taxes during the income earned period here. That's why it's a little misleading. So for that second payment, I'm not going to just pay income taxes on 2 months worth of income. I'm going to make 4 equal installments. That's what the IRS ideally wants to see, 4 equal installments throughout the year based on these payments. If you were open, again, if I open June 10th, I'm only going to have 2 equal installments, the September and the January 15th, right? So that's how you use this calendar to understand when you have to make payments. Now, I know when, but how? How am I going to make payments, right? Do I just kind of throw the money up and the government catches it? No. Let's start with the federal payments, right? So the irs.gov, make sure it's .gov because there is a .com. irs.gov payments. Going to get you to a site very, very similar to this, right? And this site has a ton of information on how you can make payments. The direct pay right there, the very first option that you see is a payment we're going to go through in just a second. That's kind of your default quick payment. But ideally, the IRS would love you to set up something called an EFTPS account, right? It's preferred. You need to set it up. It's an account where when you set it up or you start setting it up in the system, the IRS is going to mail you, and yes, it's snail mail. They're going to mail you a PIN, a 4-digit PIN back in the mail for you to be able to then complete the setup. So the EFTPS system is not something you're going to register for and be done in a day or two. It's something you're going to register for to start setup, and then the mailing will come a week later, and then you can pay. So don't wait till the last minute to set up your EFTPS account, right? And you can use EFTPS for business, individual. We're going to get to the screenshots in a second on when you sign up. But if you're a sole prop in a partnership and you're thinking, okay, I don't really want to set up this account, well, you can use the EFTPS. You can also use direct pay, and we'll get to that. You can also use credit cards, debit cards, digital wallets, right? The IRS will not get between you and paying taxes. Now, if you do use a credit card or debit card or digital wallet, they will charge an additional fee for processing, right? But if you go a little further down, you can see you can set up accounts with the IRS, EFTPS being the preferred one, to help you understand or record your transactions. Now, if you go through the EFTPS, which again is a preferred method, you would hit the enroll. When you click that enroll button, it's going to pop you up to the start the enrollment. And if you can see, you kind of go across the top there for start, enroll, review, and complete. But the very first question you're going to be asked for, and this is important, down here, enroll me as a business, an individual, or a federal agency, right? Most of you aren't going to be a federal agency, but this is where it gets confusing, right? Am I a business or an individual when I enroll to do my estimated taxes? And this is where a little confusion comes in because an LLC, which most of you are, is a state recognized organization. So if you notice, when you're an LLC and you're a single member, the default tax form is a sole proprietor. If you're an LLC and you're a multi-member, the default tax form is a partnership. And if you're an LLC, you can also choose to be taxed as an S corp, right? But all of these forms, plus sole proprietors, plus partnerships, all of those, the tax is not the business, the tax is the individual. So when you sign up for an EFTPS account to pay estimated taxes, you're going to use the individual account to pay those federal taxes, right? And then when you log in, you'll have an estimated tax form you can choose. If you choose the business, this is more for payroll, right? Because with an S corp, for instance, your owner is on payroll, and the owner is going to have withholding taxes, which are, remember, just like estimated taxes, but for employees. So if you do a business account under the EFTPS, that is to help you do withholding for your employees to pay their estimated taxes that you've been collecting, not the business's taxes, because for an S corp, LLC, sole proprietor, or partnership, the taxes are you as the individual. The only way you'd have a business taxes as a corporation when you have corporate taxes, right? And then you would have that business account. So when you do the FTPS, make sure you're signing up for the right type of account, or you won't have that option on the drop-down menu to pay estimated taxes. Now, let's say you're out of time. You're like, oh shoot, I saw this webinar too late. I have to pay this estimated tax, and I don't have enough time to wait for the mail to send me back a code through the EFTPS. No problem. Go to the direct pay site and select a reason. You're just going to select estimated tax, and you're going to fill out the rest of it, and you're good to go, right? The IRS wants to help you pay. Trust me, they do. They really do. They have a self-employed individual tax center you can get information from. They have a whole form that we'll talk about a little more, where there's a whole bunch of exceptions, rules, everything you could ever want to know on the form. There's, in fact, a swarm of forms. I love that term. A swarm of forms all over the IRS website on trying to help you understand estimated taxes and make your payment, right? So believe it or not, they are there to help, because that is how they fund the government. Now, if we flip over to the state of Maine recently, in the past few years, has created an almighty Maine tax portal where you can pay all of your taxes should you wish to, right? And again, just like the IRS, they would like you to set up or register for an account, but the easier way to do it when you're doing estimated taxes, and again, remember, the estimated tax is if you're an LLC, S corp, sole proprietor, or partnership, the estimated tax is a pass-through. It's an individual tax, right? Versus if you're a corporation, that's a different matter. So for most of you, you can just go right down to the bottom of the page where it says individuals. There's a make a payment. That'll pop you up to this, and you have the estimated payment, pop you up to another screen, and you can just use the individual income tax and complete your payment there, right? So pretty easy. As I said, paying, they're trying to eliminate as many barriers as possible because they would like their money, right? But there's a harder question. right? So now we know if we need to pay, we know when we need to pay, we know how we can pay. But the trickier question with estimated tax, and why I left it for the last, is how much do I pay? Right? And that's the number one question that usually people come up to me with. Right? So let's go through some things to remember first as we're about to think about this, right? Remember, payments are supposed to be equal across the periods. That's how the IRS would like it. If you were in business all 4 periods, and you have 4 payments. If you're in business for only 2 periods, only 2 payments, right? But equal across those periods. There are worksheets that the government has created to try to help you estimate the taxes, the 1040 ES and the 1040 ES ME for Maine, and they do have calculations on the worksheet. They're not the easiest to work through, so we'll get to a little trick later on. If your income is uneven throughout the year, I mentioned this before, if you're a seasonal business, then you can choose something called the annualized income installment method. There's a form. It's not the default, so you have to fill out the form, and the form is going to ask you, when are you a winter or are you a summer? When is your income? How does your income come in throughout the year? Because how your income comes in is how you're going to make those payments, right? So you can do that. It's going to be an estimate, especially for your first year, right? Second full year, third full year, fourth full year, you can use that trick I taught you, right? The 100% of the previous year or the 110%, depending on where your adjusted gross income was. Use that trick for future years, right? Or you can estimate each year. But most people, once they get into the second, third, and fourth full year, they just do that 100 or 110% trick to go forward, right? But otherwise, the very hardest year to estimate is that first year because you don't know what to estimate, right? You're the very first year in business. How do you know how much you're going to make? It's going to be your best guess estimate, right? Because we're trying to make those 4 payments, if it's the whole year, 4 payments throughout the year, or rather equal payments throughout the year, right? Remember, when you're doing your federal payment, it's not just your income tax, it's also that self-employment tax, the Social Security and Medicare. So don't forget that. And your state estimated tax is only your state income tax, right? So that one's pretty simple, but the federal one has that extra component. So keep that in mind. And again, before we get into how you calculate it, joint tax return filers have a benefit and drawback. So those who have 2 people on the tax return, married filing jointly, the benefit is usually that other person is an employee, right? And so, as I said, kind of with the S corps, the employee can go back to the employer and say, hey, have more federal or state taxes withheld. And they can then, rather than doing a separate estimated tax payment, if they do enough withholdings in that employee's paycheck, you can bypass the estimated tax. Remember, it's an individual tax, so the IRS doesn't care how that tax gets paid as long as it gets paid, right? Now, the drawbacks for the joint filing is you're trying to estimate your tax on everything, and we're going to get into that in the next slide here, right? So the tricky part about tax tables, if you're doing this manually, again, I have a sneaky trick and just I think a slide or two. So when you're looking at the tax table, which changes every year, right? You're looking at, if you look at the single, it's a 10% tax rate from 0 to 11,925. Now, if you earn $12,000, it doesn't mean we're going to jump to the 12% tax bracket and all $12,000 will be taxed at 12%. It just means from 0 to 11,925, that portion of the money is going to be taxed 10%. And then starting at 11,926 up to the 12,000, that extra portion, that small portion is going to be taxed at 12%. Right. So when you read these tables, it's not that you jump, okay, I made 150, so everything's going to be taxed at 24%. No, it's being taxed gradually higher as you go up in your income. So you have to kind of break the income up a little bit based on what you think you're going to make so you can understand your income tax. Remember, this is an income tax table. Social Security, Medicare, 15.3%, pretty straightforward. Income tax, moving bracket, right? And you have state tax tables and federal tax tables. Now, again, if there's two people in the income, taxpayer one and taxpayer two. Taxpayer one pays 50,000, taxpayer or makes 50,000, taxpayer two makes 30,000. So the total household income is $80,000, right? So who's taxed more, right? Do we have the 30,000 tax at, 10% up to 12%? Or do we have the 50,000 tax from 10 to 12 to more? Well, I usually tell people when you have a double income situation, one is going to be the base payer. One's going to start at the 10% rate. One's going to start at zero and go up. And then you have to add that 30,000, let's say, if 50,000 was the first one, you add the 30,000, just understand that that first dollar that $30,000 taxpayer made does not start at 10%, doesn't start at zero. That 30,000 is going to start at 12% and go up from there, right? Or 22% actually here if there's 50,000 first. So you're taking all the income and going through that tax bracket, right? So you're not starting at zero for double income. Now, in today's day and age, lucky for us, we gotta trust computers a little bit to do it for us, right? So my trick is why not get a computer program to do it? But there's a lot out there. So Pete, which ones are the good ones? I have narrowed it down. There is a link here, and it was actually this particular website was created for ride shares, right? So a lot of people who do Uber and Lyft and stuff like that, they often have other jobs and they're doing this as a moonlight job, right? So they're often saying, well, what do I do for estimated taxes? So they create a website for them, but it happens to be a good website to use for you as well, right? So there's the link to the website. And when you go through it, and I'll go through it, just briefly. Let's say we're married filing jointly like we had. Remember the 80,000, we had 50 and 30. So let's say self-employment income was 50 and, it's going to say, okay, based on just 50, this is what we have. But hold on a second, Pete. You know, we need to use the advanced one because we are married filing jointly. So there's multiple incomes going on. Okay, we go to the advanced and we can say, okay, I have self-employment income, I have wages and salary, right? I need to break this up. Now there's a few other screens, as you can see, 4 out of 8. But when we get to the end screen and we have that $80,000 broken up 50 and 30, it's going to take all of that information that you put into it, and it's going to get us, what is your taxable income? What's the income tax, self-employment tax, total tax liability, right? It's gonna do most of that for you. Now, again, it's only as good as what you enter into it, but it lets us know, hey, your total tax liability is 9,508. It estimates that that employee is going to withhold 4,138. So the leftover liability of 5,370, you can make four payments of 1,342 and you're good. So this website, once you enter everything in, it's going to be able to pop out what it thinks your four payments should be. So as I said, it's kind of like a little cheat that I like to think about. Now, if you do single and you only put in your self-employment income, there's no taxes you withhold, right? Because that's only for if you have employment income that is employee employer, right? So this is a nice little website that you can go through. Again, this is focusing on your federal tax liability. It does not focus on the state tax liability. So this is a nice little tool to try to help you estimate your federal tax liability. State taxes, of course, there's a computer program for that too. So this is one that I found that I thought was relatively good. Be careful though, a lot of tax estimators that you find online are going to assume you're an employee and not self-employed. So if you do find a tax estimator, other than the ones that I'm pointing out here, that's fine. Absolutely, absolutely awesome, right? There's even TurboTax as a tax caster, which is pretty good too. But you're going to want to keep that in mind. Okay. Now, let's say you didn't pay estimated taxes, wah, wah, and you're saying, are there any ways I can get out of this penalty, right? I got this penalty. So the IRS is willing to waive the underpayment penalty if you became disabled during the year, if you're at least 62 and ended up retiring, if you experience a casualty, disaster, or other unusual circumstance. So we do know there has been a lot of natural disasters around the US, so that might qualify. Or the very final one, if this is your first time experiencing something, if this is the first time you're making estimated tax payments, you haven't before, you can claim something called the first time penalty abatement waiver. You can look it up. The IRS cannot mention it. It has to be something you mention, right? So when you're on the phone with the IRS saying, hey, I just got a penalty letter. It's the first time I paid estimated taxes, didn't quite know what I was doing. Can I use the first time penalty abatement waivers? You want to use those words. They will waive the penalty. They will not waive the interest that you earned on the penalty, but they will waive the penalty, right? If it's the first time. So if you've been paying estimated taxes for 20 years and you screw up, this isn't going to work, right? So this is the first time you're experiencing something, and this works for estimated taxes. This works for other things that you're experiencing for the first time. That's why it was set up. It's that one oopsie, I didn't realize that was what I was supposed to do or what I did. I did it wrong. This is something that you can use to try to help you, right? So, in summary, we need to understand what estimated taxes are, understand when and how to pay, understand how much to pay, and pay on time in equal amounts, right? That's the important one. Thank you. Here are a whole bunch of resources. As I said, you will get the slides, but I know that some questions popped up in the chat, and I believe I left myself a good amount of time. I talked really fast. Wow. So I left myself a good amount of time to answer any questions. So I'm going to leave this up for just briefly as I open the chat so I can kind of cruise through questions, or if there's anyone on there that I got the hello, Liz Stefani. It drives me nuts that the payment periods aren't equal to each other. Yes. Remember, the payment due dates are set up wonky, right? 3 months, 2 months, 3 months, 4 months. But the payment themselves are supposed to be equal payments. Now, this is not legal advice, but something I've experienced is that I have had clients who just send in payments as they're earning money, right? I told you not to, and that's not how the IRS wants you to do it. They want four equal payments. But I've had people put in just the amount that they earned during those periods. And as far as I know, they've never been penalized because they did make some payments, but that's not how you're supposed to do it. So technically, they could be penalized. But yes, the calendar of schedule of payments, I don't know why it happened that way, but that is how they decided to do it, right? Um, and then someone overpaid, right? So this is just like your taxes that you do if you were an employee before. If you overpay on your taxes, if the IRS says, you're doing your tax form and it says this is how much you owe, oh, guess what? You paid too much. They're not going to say too bad, keep it. We're going to keep it. They're going to give you a refund, right? So if you overpay, it's okay. They're going to give you a refund. If you underpay, well, then it comes down to did you pay 90%? Did you pay 100% of last year's taxes or 110, depending on your adjusted gross income? Is there going to be a penalty there? Because remember, if you did 100 or 110% of your previous year's taxes, even if you owe money because you did really good, you did double what you did last year, that's okay. Yes, you will owe taxes because you had more income, but you're not going to get a penalty for not paying estimated taxes because you did pay estimated taxes. And as far as the IRS is concerned, it's reasonable to assume your business, continued on the path it was, right? Um, Yeah, so I'm trying to see. So when you're entering stuff into the tax calculators, usually you want the income that is is your net. So if not sales, right? Not the total income you made, but sales minus expenses, that's what they're looking for is a profit on the business because that's the profit is what you're going to be taxed at. So the question was, when we enter information into the tax calculator, what numbers are we putting in? Right? Well, as a business, you're only going to be taxed on the profit of your business. So it's sales minus expenses comes to the profit, right? If you're a W-2 employee, then box one is what you're going to be taxed on, right? Um, do you have to pay estimated tax on rental income? That's kind of a trick question because rental income can be classified two different ways depending on how your accountant or how you classify it. Rental income could be supplemental income, which is a whole different tax form, or it can be set up as a business. If it is set up as a business and it's not supplemental income, so additional income, then if it's set up as a business, then it's just like any other business. You're going to pay estimated taxes on that income. Again, you're paying taxes based off of the profit you think you're going to make. The supplemental income, just a side note, the difference there is it's supplemental income. It's not your primary source of income, and you pay income tax on it, but not Social Security and Medicare. A little tricky because when PPP came out, it was based on business profit and not supplemental income. So there are some people who did not get PPPs because they classified their rentals as supplemental income. Again, getting a little in the weeds and not tax advice. So the accountant, that's what you get accountants for, so they understand these questions. But again, if you're running your rentals as a business, then yes, just like any other business, you'll have estimated taxes on the profit. Good guess on a common question I get is, I'm a first year in business. I I have no idea how much income I'm going to make, and not only that, I have no idea how much profit I'm going to make because even you have to estimate the income and you have to estimate the expenses that come up with the profit after, right? Only what you're going to be taxed on. Um, I'm sorry to say, I mean, you could work with an SBDC advisor to try to come up with a projection. So oftentimes when you're first starting out in business, you want to kind of project how you think it's going to go. So you start with your projections on what you thought would be good. There's no easy answer to that. As I said, the first year is a complete, sometimes guess. Ideally, your projections are within what you thought it was. You could make a educated guess. You could go high, but then you run the risk of paying too much and not having that money available for the business. Um, you could go low and take the penalty. Remember, the penalty is based off of how much you owe. So if you did pay some, there's not going to be as much a penalty as if you didn't pay any, right? So for the first year, it's hard. Second year, no problem, right? The 100% rule or the 110%, depending on your adjusted gross income. I always go 110 just to be safe, but you just do 100% or 110% of the previous year. So that's an easy rule. But when you're your very first year, that's hard. Uh, so when you do the question in the chat is, so you pay these estimated tax returns or your estimated taxes throughout the year, and then you go to file your tax return. How do they connect, right? Because you don't want to pay any more taxes. So when you file your tax return, the majority of the beginning of the tax return is all about your income and any situations that pertain to you and any credits like child tax credits that you're going to get. And if you look right before, or it's going to come up with your tax amount for that income, and then right after that tax amount, it's going to say, hey, this is how much taxes you paid, right? And if you're an employee, anything you had entered on your W-2 is going to be, as far as income taxes withheld, is going to be put down there. If you paid estimated taxes, you're going to put how much you put for the estimated taxes on that line. And it's the total tax minus what taxes you paid is what taxes you owe, right? So it all folds into your tax return so that you're not paying any more than what you owe. But again, with your tax return, you don't look on the first page, it's on the second page that you'll see Once you do all the calculations and come up with what tax you owe, then there's a line for what taxes you have paid. And if you're using a system like TurboTax or H&R Block, it's going to ask you, it's going to walk through those questions of, oh, you paid estimated taxes? Let's pull up a schedule and see when did you pay them and how much did you pay. And side note, I would always keep receipts, right? Screenshots of, hey, I paid my estimated taxes. Here's a screenshot of, you know, April 1st when I paid my first payment, so that I remember what day I paid and how much I paid, right? Now, if you set up an EFTPS account, you'll have all those records there. I would still keep another record just to make sure, right, that you have the record. But if you set up an account, you will have the records hypothetically there too. But any payments you make, you record on your taxes, and then that's going to count as a credit towards whatever taxes you owe. Okay, oh my God, we have a whopping 15 minutes. I had so many slides. I'm going to stop share. I really went through that quite a bit. And let me see if I can pin myself. There we go. Oh, we got another question. Good. You mentioned the federal form 2210 for seasonal income. So that form is a federal form, I believe. 2210 or maybe 2200. I had 2210 in the presentation. So that's when you're doing the federal tax. It's going to take your season and it's going to have you break your season up into 4 different categories. And based on where your taxes are being, or where your income is being earned the most, is which period you're going to pay the more income in. Seasonal if you're running your business year round, but you're seasonal. Yeah, so this works if you're year round, but you have, let's say you're a wedding venue, right? Because I know a lot of wedding venues now are doing winter weddings, but the winter weddings aren't as popular as the spring and summer weddings or autumn weddings. So you're going to have this big fluctuation. So your last period is going to be worse than your first couple periods, right? Perfect example. It's year round, but we have a difference in income throughout the year. So perfectly fine. As I said, if you don't, do that adjusted income form, then you're going to have to do the equal installments regardless of when your income comes in, right? The equal payments. If you do decide, hey, I would rather pay more when I have more money and less when I don't have money, then you're going to want to submit those forms and get into basically a payment schedule that you agree with the IRS, and they give you the details on how to do it. There was another one. If we're still under the less than 1,000 in taxes, exemption will likely be for a while. Should we set up an EFTPS account now or wait until we're more likely to have to pay estimated taxes? I mean, this depends on how sure you are that you'll be under the less than 1,000 in taxes. If you're pretty positive, if this is a pretty small business, and you're getting up and running, so you have a lot of equipment that you're buying, so your sales, mind if it's expenses where that equipment comes in, so your profit is pretty low and you know it's going to be that way for a couple of years, then hypothetically, yeah, if you know you're going to fit that exception where you don't have to do the estimated tax payments, then you don't have to sign up for an EFTPS account. The only worry I have is if you get into that oopsie situation where, we're making a lot more than I thought we were, then you're kind of like, okay, now I need to set it up. But you're not required to set it up. You're not even required to set up EFTPS. It's just the preferred account. So you could always default back to that direct pay account, which is a little faster than the EFTPS because you don't have to set up an account. You put your bank information in and it takes it from the bank, or credit card or debit card with fees. Hopefully that answered that. Other questions on estimated taxes, right? Don't make me sing, people. Don't make me sing. It's not a good thing, right? That's what I do when there's no questions. Any other questions? Ironically, once I mentioned singing, I saw someone else jump on the webinar. So maybe they do like my singing. Estimated taxes, all in all, nothing to be scared of. It's definitely a doable task, right? You do need to put some thought into it. Take some time. The websites that I put in the webinar are definitely good guides, right? They're not going to, I won't count them as exact, right? But they are good guides. They're doing a lot of calculations in the background for you so they can get you a good estimation on what you think your estimated taxes would be. Um, Worst case scenario, if this is your first year, right? So we have that person that was worried about the first year. How do I estimate it? Worst case scenario, if you do get a penalty letter from the IRS saying, hey, you didn't pay your estimated taxes or you underpaid or whatever, if it's the first time you're encountering it, then you can do that first time taxpayer abatement program. Right? You can get that waived. Again, there'll be interest, right? I myself have used it once, truth be told. And they waived the penalty, but I did owe, I think it was like 48 cents in interest. So there is interest on the penalty that you'll owe, but otherwise you'll be able to kind of waive that. Again, it only works when it's the first time you're encountering something, estimated taxes or otherwise, right, for a business. Other questions? I'm guessing people are going to play my webinar back at half speed because I think I talked quite fast, but that's okay. You will get the slides. This will be put on YouTube in case you're catching this later, which is fine. Those who signed up will get a link to the video so that you can watch it later as well if the slides aren't enough or watching it the first time wasn't enough. But as I said, the main SBDC is a resource to use. So please feel free to reach out. In the corner here should be my email address, peter.harriman@maine.edu. Um, and if we don't have any more questions than what we had in the chat, then I will give you back 7 minutes of your day. I will stay on till noon, though, just to make sure anyone who had a question but didn't necessarily want to ask it right now um, gets a chance to do it. So if you're on and you're like, great, that was great, you want to get to the rest of your day, go for it. If you still had a question, stay on and I can certainly answer it for you. But otherwise, thank you for coming. Thank you for trusting me with the knowledge that I just gave you, and please use it well, right? Otherwise, have a great SBDC day, right? Thank you. Happy Wednesday. Yes, the sunshine is out finally. I am hoping to have it. And again, I'll stay on another few minutes in case there's someone who's a little shyer than the rest. Yes, it is National SBDC Day. As I said, I didn't want to, but I can start singing, right? My default is, let's talk about taxes, baby. Let's talk about the 1040.